The Abbey Carpet Business Empowerment Series is a Rehmann podcast geared toward franchisees. Our industry professionals will link real clients and experiences to the relevant business solutions and topics affecting the franchise industry today. Enjoy the episode.
Good afternoon, everyone. Thank you so much for joining us today. My name is Brett Nesbit, and we are here for another Empower Your Purpose by Rehmann. Today's topic is going to be succession planning, and specifically, we're going to talk about some of the things that have come up in my conversations over the last few months with our great colleague and friend, Abbey Carpet and Floors to Go. So let's get started. So let's welcome our two guests today, all the way from Detroit, Michigan, and you have to say Detroit. It's not Detroit, right?
Correct. Right.
Mr. Tom Wiggins of our Wealth Management Division. Tom, welcome.
Great. Thanks for having me. Good to be here.
Tell us a little bit about yourself and what do you do?
Sure. So I work, I'm a wealth advisor in Raymond's Wealth Management. And, I've been doing this for 30 years, believe it or not.
Really?
Yeah. So I've been through the go-go 90s, right? Markets up, 2000s, recession, Great Recession, the 10s, COVID. And I really just specialize working with business owners, guiding them through those processes.
And you and I have actually been on the Abbey Carpet World Tour for quite a while, haven't we?
We have. We've been to a number of conventions all around, looking forward to the one coming up and working with the franchisors and franchisees and Abbey Corporate and everyone involved.
Now, did you bring your Abbey Carpet Concert Tour t-shirt that we have made up? Did you?
Oh, yeah. Getting ready for the next.
Sold out on the back.
Sold out for Nashville for the next concert.
Absolutely. So did you bring your ukulele this time by chance? Because I know they always have you up for a number when we go to those conventions.
Yes. So. I'm a little intimidated if we're going to Nashville and playing the guitar and the ukulele. I'm not sure.
Well, there is that. Now, tell us about your background a little bit, because you went to a very prominent school in Michigan, if I remember correctly. Is that true? Did you not go to Central Michigan University?
I did go to Central Michigan, and I think you went to a very close school, a little competitor, right?
Well, I did, but see, my school was a little bit different because we don't have like those mail-order diploma things that they have, like Central does. So we actually had to go to the school. You actually had to attend classes where I went. So I wasn't sure if that was the same for you.
It's really interesting, but our mail order diplomas are really good because I just noticed reading an article that we were the fourth best university in the state of Michigan.
Really?
Fourth best? And Western wasn't 1, 2, or 3.
Was not really. That's interesting. It's amazing what money can buy.
It is. Yes,
isn't it though?
It is.
Well, I'm really glad you're here. And again, you and I have worked with the Abbey people now for several years. This is probably your 7th or 8th year we've worked with them, isn't it? For
Absolutely.
It's been 10 for me. And they had just been fantastic clients and colleagues of us. They have been so gracious. They allow us to speak at their convention every year. They invite us to their convention every year in spite of you and I showing up. And they've just done some wonderful things for us over the years. So we're very grateful to have them.
We are very much so.
So now here's the tough part of this, Tom, because the IQ in the room is going to go up a whole lot. And when we start introducing our next guest, the problem is I have no idea how to say her name. So how about if we just call her Mary Smith? Mary, welcome.
Yes.
Tell us what your real name is.
So great to be here, Brett. Thank you very much for the invite as well. So my name is Sladjana Vojcanin. I'm with Rehmann's Valuation Services team. Actually, I'm new to the Rehmann family.
Yes.
We came in with an acquisition last month, with the acquisition of Vestal and Weiler, Central Florida accounting consulting firm in the valuation group. So yeah, I focus on business valuations.
I've been doing it a little while from what I understand.
Just a little bit. It's hard to believe.
Yeah,
almost over actually 25 years.
Well, and so just a real quick plug for the new firm. Thank you again so much for joining us. Vestal was a great firm. We've been working with them for a little while. They finally decided to pull the trigger and come and join us. And just having their presence in Orlando is just going to be fabulous for us in the Florida region and the whole firm. Just the people we have met thus far and the culture and all that sort of stuff is just great. So we're glad that you're here with us.
We're excited to be here.
Oh, that is so awesome.
Yes.
So shall we talk a little bit about succession planning? I mean, that's our topic. Or maybe we should just talk about ourselves for the next 20 minutes. What do you think? Should we? Let's talk about succession planning. It's way more interesting. So again, what I had mentioned before is that I've had the very good fortune of speaking with a lot of the franchisees out across the country. Abbey has something like 600 or 700 of them throughout the country. Haven't spoken to all of them, but everyone that I have, invariably the conversation leads back to some sort of transition planning, some sort of succession, whether it be a third party, whether it be family, whether it be the employees. All of that keeps coming up in conversation. And I think that's probably a microcosm of what's going on in the business world anyways. But in this particular setting, this particular group, it's really at the top of their minds. So my intent today, of course, to have you two experts in to talk about some of the wealth management ideas that we have, how you go about valuing a business, and what are the things that Rehmann can do to help them with that. And then I'm a tax person, so to also touch upon the tax side of it as well. So, in a transaction, we all know this, but for our audience, you have a buyer and a seller generally, right? You have two parties. So let's start with the buyer side. So Tom, from the wealth management side, we have a buyer. We have somebody that we're dealing with, and they want to buy an Abbey franchise. What should we do with them? How should we help them in terms of the wealth management aspect of that?
Sure. Yeah, it's a great question. And, in working with the buyers, first is, well, how are they going to be able to finance that purchase?
Sure.
That's the first thing that comes across. And there's a number of different ways. Obviously, the easiest way would be cash, but, that might be hard to come by.
Yep. Not everybody has liquidity, right?
Everyone has liquidity. So they kind of look at some other options. You got family, friends, maybe having a partner come in. It can be very involved, active or passive partner. You also go to the bank. They have bank loans. In particular, they might even have work with SBA, Small Business Administration,
yes,
which I'm sure, Brett, you're probably familiar with. And really, that's a program that you get through banks where the federal government backs 75 or 85% of the loan for the bank. Now, it's not free money. You still have to apply, and the application process is pretty rigorous to get that loan. It can be anywhere up to $5 million, and they have some kind of micro programs even within the $5 million.
Yep.
It's available. It might be 7 to 25 years, and the interest rate can be fixed or variable. So those are kind of three more traditional routes. And there's a fourth route that's available called ROBS, right? Small business, yes, rollover small business loan. And basically how that works is if you have a prior 401k or an IRA, you can actually use those funds to loan kind of the corporation the money to buy the business. Right.
Within your IRA.
Yeah,
correct?
Correct.
Yeah.
And usually how you're going to set that up, first you have to have a prior 401k. You can't be working and using one unless that plan has rules you can take money out. And then you're going to set up a retirement plan within the company. And that company has to be a C Corp. You're not to get in the nitty gritty. And Brett can get through all that. But it has to be a C Corp, no other structure. Then you have the retirement plan. You have to be an employee of the S Corp. The C Corp. And then you also have to be a beneficiary and employee of the 401k plan that you've set up. You roll the funds in to the retirement plan. You buy the stock, C Corp stock, and then there's your proceeds to buy the business. And what's great about it, there's no penalties or taxes for that process. So we find in working with franchisees or those trying to buy a business, that's a viable option for that. Now, a couple of things you need to consider is it is retirement money. And as a planner and as an advisor, we never want to, have a zero retirement bucket. You want to take that into account. Two, it is a C Corp, which is not as tax efficient as an S Corp, as you know, right? And then also there's just more reporting requirements, compliance annually for that. But it is certainly a good option that we've used. And there's companies out there that can help with that to get that financing going to buy that business.
Yeah, we've done a few of those over the years, and they are really, really a slick option for those that want to stay active and stay involved. So you effectively buy the company, you're buying your company for your retirement, and then you're working in it. It's not really a hands-off deal. So you have to really participate because it's your retirement money that's just bought that business.
Correct.
So that's not sitting on the sidelines anymore. It's working for you and you're working for it. So, but the tax efficiency of that is really, really an excellent program to use if you have the availability to it. So, that's a really cool idea. So, what we try to do in these transactions, of course, is try to be as tax efficient as possible. So if people don't have access to that and they don't have necessarily a lot of cash on hand, I mean, I've unfortunately come into the circumstance where people have had to sell securities or they've had to have taxable events in order to buy a business. So I'm sure you've seen that over the years.
Sure. Yep, absolutely. And that's something you want to be considerate of. If you're selling an asset, you're going to pay, taxes probably, capital gain, short-term or long-term. How does it impact your overall financial plan? Yeah, we don't want to put all our eggs in one basket, putting everything in for this business. I mean, hopefully it succeeds. There might be times it doesn't or doesn't do as well. And now you're kind of starting over again.
Right.
For when you might want to reach, if it's retirement or, different career paths or legacy, estate. So a lot of things you need to take into consideration. Like any small business owner, right? You're taking the risk, right? I mean, there's rewards for that, but just make sure you're planning, bring your advisors, Brett, the Toms and attorneys of the world to help you guide you through that process.
Well, at least bring Tom. At least bring somebody smart.
I did talk a lot about tax right now, didn't I?
I was kind of surprised at that. Good job.
Yeah.
Well, maybe we should switch seats.
Yes.
Why don't we do that?
Yes. Your side seems more exciting.
Oh, this is way more fun. I asked the question.
That's
So,
right.
let's talk about the buyer side from the business valuation perspective.
Sure.
Buyer comes in, says, "Hey, listen, I want to buy this.
Mhm.
What should we do? What are the first things we should think about when
Sure.
we're on the buyer side and we're looking at a business, evaluating it?"
Sure. So really, there's many aspects to the business valuation and how we fit into the mix. So really, when we're approached for, let's say on the buyer side, it's like they may already have some estimate of value in their mind, but they would like perhaps another third party opinion just to kick the tires, make sure it's still within a reasonable range. So we
You don't just get it out of a book.
no,
You don't just
we're
look it
thinking
up?
of a number 5
What?
times,
Hey, wait a minute.
4 to 6 times EBITDA.
Yeah.
Yeah, it works.
Doesn't work that way? Oh, that's surprising.
Yeah. So, we're frequently called upon, for similar types of engagements
Yeah.
to assess or determine what is the market value or the fair market value of the overall enterprise value. And there's various types of valuations that we can perform. Some very frequently, it's like they're looking for a higher level indication of value.
Mhm.
And, the process is very similar in all types of valuations. We issue it. Initially we scope the project, determine exactly what it is the buyer is looking for, what type of a deliverable, what's the scope of services, issue a data request in terms of the whole valuation process. The data request is fairly lengthy because we do have to go through various processes, make sure we're analyzing historicals, future cash flows, understanding what we're looking at in terms of market multiples. But
Sure.
it can be a little intimidating, but we always like to reassure our clients that we can talk through a lot of this. They don't have to actually provide written responses.
So maybe at a high level then, because again, if I'm their tax accountant, I've been working with them for a number of years, we're obviously trying to be as tax efficient as possible. So we're trying to lower taxable income. But now it's time I'm the buyer. I want to take a look at this business, and I see that they have tax losses for the last 3 years. Well, that doesn't make sense because they told me that this business makes a lot of money and everything is great and all that sort of stuff. So that's where I think you come in. So tell us a little about that when you have perhaps a tax-basis set of books. We don't have to get into too much of the weeds, but tell us about how you sort of unravel that to get to a true value.
Well, depends on the situation. Frequently, we're relying on taxable income, or we're relying on internally prepared financials. We try to reconcile what are the differences, what are perhaps deductions that they've taken for tax purposes. We try to normalize the bottom line earnings or EBITDA or revenue to a stable, normalized level that we would expect to see a company of this nature to see what the stabilized earnings would be.
Sure.
So that's really, it's like we try to understand what are these discretionary perhaps expenses, what we need to normalize for purposes of the valuation. So more so like one-time perquisites or extraordinary items or discretionary items to get to that normalized, stabilized cash flow that any third-party buyer would expect to achieve in a company of this size, in this industry, in this geographic space.
So, I mean, a lot of these are very balance sheet oriented companies. I mean, they have inventory. They won't have a ton of fixed assets, but they have trucks, they have delivery, they have all that kind of stuff, which of course is heavily depreciated for tax purposes as quickly as we possibly can. How does that come into play when you're looking at the balance sheet side of the company?
When we're looking at the balance sheet side, really what we're trying to understand is what is the market value of each of these underlying assets. But when it comes to valuation, depending on the type of company we're valuing, if it's a normal operating business, let's say that it's not very asset intensive, that asset-based approach perhaps might be the floor value from a valuation perspective. We're more so going to rely on the future cash flows or looking at the historical cash flows, stabilized cash flows to determine overall fair market value based on the income stream. But we'll also look at market multiples, look at, depending on the size of the company, if there are some publicly traded comps, we might look to market multiples there. But we'll also search many of our databases that we subscribe to see what recent transactions have occurred within this industry space to which we can apply various either revenue or earnings-based multiples to this company. So we ideally want to look to the income or the market approach. If it's a going concern, not very asset intensive, but that asset-based methodology, we will occasionally rely upon, but it's facts and circumstances based.
Oh, that's really interesting because, again, the people that are in the franchise business and the floor covering space and all that sort of stuff, our clientele, work really hard at what they do. And it's really an income statement driven process. I mean, again, the inventory that they have generally is what they're trying to turn over and make money at. So there's not a lot of big plant and property and equipment type stuff around, but certainly the inventory is a part of it. So Okay, so now we're at the point where we're gonna sell this thing, and we're still on the buyer side. So Tom, we're at the point of sale. What are some of the things we should be thinking about when we actually get to the table?
Right. So we're getting ready to sell our business,
We're
right?
getting ready to
Yeah,
sell
we're
it.
ready to sell. So, we always talk about the number, right? What's
the
the
number?
number?
Yep, what's the
What's
number?
the number that we need? Is it 500,000? Is it $1 million? Is it 10 million? And, when you think of that number, how does it impact? Are you going to stop working? When you're officially retired, are you going to do some part-time work? Are you going to change careers, do something else? So that's going to impact kind of what that number is. And, when you have that number, just throw everything in there. Throw in the kitchen sink. You want a second home, you want to live close to family, want to buy a boat, whatever. Just what is that number going to be? And then we kind of break it out, from an asset, kind of a spreadsheet, income statement type. One, we have our balance sheet we're going to look at that says, all right, we're going to sell the business for X amount, let's say $1 million. There's cash flow there. We have our retirement plan. There's an asset there. We have some other savings. Then we're going to look at the income side. Well, what income are we going to receive? Of course, you have Social Security, depending where you are and what age.
Sure.
Maybe you have some annuities, maybe you have a pension, or maybe the buyout is going to be in some type of 10-year installment plan. So you want to take that into account. And then you take that big bulky number of your, the number, and you kind of break that down into annual cash flows for better example, right? And let's say I need $80,000 a year from now until my life expectancy, which was different for everyone, but let's just say 90. So we'll throw it out there. So we put all the information together to develop this plan, and we actually come up with numbers. So just like the valuation, you get a number, right? And so we're going to have this number, and at the end, it's going to say, well, you can spend, $90,000 per year based on assumptions of growth, inflation. And if your goal was 80,000, you could spend 90. Hey, you're great. You can sell that business for $1 million. Given these assumptions, you're good. I wonder if that number comes in at 70,000, you have to spend 80. You want to spend 80. All right, well, do we sell our business for more? Do we work a little bit longer? Do we have a part-time job? So the idea is just kind of providing, we call a roadmap. So you kind of know where you are, where you want to get to, and how do we get to that point? There's be some challenges, some opportunities. At least you know what to work with. Going back to the number, and you're not going in blind, because believe it or not, less than 1 in 4 business owners actually plan.
Yeah.
So that's a lot. They're not planning.
Amazing, isn't it?
Right. And they the valuation might come back like, what? It's only 500,000. I was planning on $1 million. It's only 500. And that could be pretty disheartening, right? So you just get the team members involved, the plan. So you're just ready to go. So when you go out there for that offer, you get it, you're done, and it takes a lot of stress out of the process.
Yeah. Before they slide the check across the desk, it's kind of a good idea to know what's going on. And actually, I'm actually 85 years old. I don't know if you knew that or not.
Wow.
It's actually, it's all the facelifts. Seems to work pretty well.
And you love your job.
And I love my job, and I love working with Tom. So yeah, I totally agree that that's where the wealth manager and the tax person really earn their money, in my view, in these types of transactions, because you need to know that. I mean, they may have the gross number, but maybe they haven't thought about the tax effect of that. If there's going to be a large gain that they're going to have to pay tax on. And so we work together, and you and I have done this over the years, where we work together to come back to the buyer and say, listen, man, this is what it's going to be. So get ready.
Yeah, that's a great point about the taxes, right? Because you think, I got the capital gains tax, but then, that adds on to your income tax, and you got some other taxes that you don't think of. And like, well, I was at 15 or 20, now I'm at 25, 29, and the buyer, you didn't think of that.
Yeah, I didn't have that.
Selling it.
I didn't have that in mind.
Right.
Absolutely. So again, okay. So as we're walking around here, so buyer side, getting close to the end, we're getting right to the signing date. What are the things that we should do from your perspective to close the deal?
Oh gosh, that's a loaded question.
Well, yeah, I mean, there is that.
I guess really thinking about what perhaps we can do on the valuation side, or perhaps another service offering to think about is kind of touched upon, let's say, normalizing, understanding what the stabilized cash flows might be for the company, but
going forward, right?
Going forward, or even leading up to that, that discussion with the buyer. Frequently, the buyers are another team, the quality of earnings, the transaction advisory services team would come in and really do a quality of earnings, perform like a due diligence on those historical financials to identify some of those discretionary, one-time, perhaps gap-related adjustments that are going to get them to that point, to that discussion table in terms of understanding what the cash flows are, what the revenues are, for determining that final valuation.
Yeah, I know we touched upon that a little bit. The quality of earnings stuff is really becoming an important part of the buy-sell world out there today. And my limited knowledge of it, because again, we have a team within Rehmann that just does exactly that. But it's put in place to give people a degree of comfort.
Yep.
And as you say, sort of come to a value
Mhm.
and have, I don't know, it's maybe a poor choice of words, an expectation of, hey, listen, these earnings are going to continue.
Exactly.
That, once seller goes away, particularly in these family-owned businesses where, seller has worked their whole life and they effectively are the business. When they go away, are those earnings still going to be there?
Exactly.
Yeah, absolutely. Well, let's switch to the seller side then, shall we? So Tom, going back to you, you're now representing the seller, and I'm getting ready to sell my business. What sort of things should I be thinking about?
Sure. Yeah. So you're ready to sell. I think we talked about evaluation. We talked about, planning, right, for that sale. How's our investment structure going to look like once we get those proceeds, right? We've got this check now, right? Slides across the table, as you said, and we got this check for $1 million. Well, what do we do with it?
Right.
And hopefully we've already built the plan of, what's enough, what do we need, what's the number, and then you know how to invest that money based on the allocation of risk. And that's different for everyone. You might retire at 50, you might sell at 65. There's all different times. So the allocation is always going to be different and customized to what your risk is. Some individuals might be able to just invest in bonds because one, they don't spend a lot, and two, they've got enough proceeds and their expenses aren't that high. That's fine. Others might need to be more balanced. What you want to be careful of is, don't invest. Well, I need to get 10% to sustain my retirement after I sell the business, because there's a lot of risk. And as we know, this year, you'd be down quite a bit if you're expecting 10%.
Yeah, things aren't looking so rosy, are they?
Not so rosy. So we want to make sure we build out a diversified plan. That's, stocks and bonds, and it could be some annuities for fixed income, for example. You could, private equity for illiquid. So there's a lot of different ways, but we try and structure that transaction, and going forward, we try to divide it up in like 3 buckets, right? We have our expenses, and we say that was the $80,000 number. We need to generate, maybe we need to take out $2,000 a month. Well, we make sure we have a year or 2 years worth of cash. So it'd be about like 24 to 48,000. Sitting in cash in a savings account is not fluctuating, right? It's just there.
It's there. It's there for you.
For 2 reasons. One, you don't worry about the market. Like this year, can you imagine if you had to sell every month with the market down? That's a double negative, right? You don't want to spend and sell at the same time. And then 2, just provide peace of mind. Hey, next 1 or 2 years, I've got cash here. It doesn't matter what's going on around me. I'm covered. Then you might go medium term. It might be like 2 to 7 years, more income, bonds, some dividend stocks, for example.
Sure.
And then 7 years or more long-term growth, right? Because you've got time. So the market could be down for a couple of years, but I'm not going to touch that money for 7 years or more. I can be a little more aggressive. And so you kind of keep those separate buckets. Again, it's all about the planning and being comfortable in the psychology, really, of, hey, I'm okay. We did the plan. We know how it's going to work. We do these things, and it just makes things a lot easier for you as you go on to the next stage in your life.
Yeah. I mean, you may not be familiar with this. You've only been with the firm a month, but it's the as is should be barriers payout.
Yeah.
It's back to the old Carnegie stuff where, where am I at today? Where do I want to be? What are the hurdles I have to overcome? And then once I get there, what am I going to do? So big picture question again, for all of us is, so many of these businesses, as we know, Tom, you and I, are family owned businesses. Mother or father, or even grandmother and grandfather started the business, transitioned it down. It's now time to transition it again. And these people have worked their whole lives to build these businesses, right? So family member now comes in, adult son, adult daughter, whatever, and they're going to take it. So, there's gifting strategies, there's estate and trust things that we can talk about. There's all kinds of things in that realm, which I know that you and I would touch upon if we worked on one of these types of transactions. So from the gifting perspective, again, just from the tax side, there's a lot of really interesting little intricacies that you can do with that. And then also from the trust and estate side of it, there also are a couple of other things. I won't quote you code sections because you'll be asleep in mere minutes here, but a couple of things which you can do in terms of reorganization, or asset versus stock purchase, those types of things that are really, really elegant, nice solutions for people that sometimes don't get brought up. So I know you deal a lot with families, and you do a lot of business transition stuff with families. So just thought if you had a few comments on that.
I think one, mentioned just from a tax, I mean, sometimes you can get what they call a discount on the basis of how it's structured. So it might be worth $1, but maybe it only costs you 70 cents to pass it on to the next generation. So you're saving 30% on that transaction. So there's things like that. And you can structure, a general partnership, limited partnership, and gift shares within, the $17,000 limit effective in 23. So a lot of creative ways of how to go about that in a very tax efficient manner and still have control, which is a big thing too, right? You just, every family is different, as we know, right? As we worked with, right?
Right.
Some are very comfortable giving complete control to the family member, and others are like, yeah, I really don't want to give it all to them. I want to sit out. So there's options there, strategies based on what your goals are. So don't feel that you're just kind of pigeonholed into one way of doing it. There's a number of different ways to process that, transaction that works out for everybody.
Yeah, it really does. So, seller side for you, I know you deal with those as well. And, some of the stuff we're talking about, be happy to hear what you have to say about what happens on the seller side.
Kind of like what Tom initially alluded to in terms of like the sellers, they're perhaps looking to go to market. They might have an idea of what the company is worth, but perhaps limited basis for it. So that's frequently where we're called upon to say, okay, we need to perform a higher level valuation, let's say calculation of value, to provide an indication, a range of value for them to perhaps go to the negotiating table with. But kind of what Tom also alluded to in terms of like on the gift and estate tax planning, perhaps maybe even before they start going down the path of a transaction, working with the tax advisors like yourselves to identify perhaps some creative strategies to transfer to that next generation, to take advantage of certain discounts that would be applicable perhaps to that interest that is being transferred to that next generation, specifically for discount for lack of control. If you're looking at a non-controlling minority share of a company, privately held company, there are these discounts, lack of control, lack of marketability.
Yes.
Even Tom alluded to where frequently perhaps the parents don't want to necessarily give over all the control, and the company is capitalized with voting and non-voting stock. They may gift that voting stock where there's a further discount applicable to that pro rata share. So there's various strategies that perhaps they might want to start thinking about, perhaps in advance of or right at the same time of going to market. So there's a lot of creative ways out there.
Yeah, there are. And we always say that, if you come to us and you say, I'm going to sell my business in the next 6 weeks, you've probably come to us a little bit too late.
Yeah.
I mean, it's a 2 or 3 year process if you're really, really into it, particularly from the seller side. Let's start building up our earnings. Let's start making our balance sheet look good. Let's clean things up that maybe have sat there for a while, all that sort of stuff to hand over a good set of books to the next person, whether it be family or a third party or whomever.
Yeah.
Let's make sure the books are clean so that the next person can take it. And if you're going to do any sort of installment related payout, you're going to want to have that. You're going to want to have a clean set of books that you hand over to somebody.
Yeah, absolutely.
No question.
Right. And, you also by planning, you're going to get the most value for the business. That's all we're trying to do, right? If you're doing it in 6 weeks, you get that private equity call.
Yes.
Hey, we want to buy. Like, wow, this is great. And then you're not prepared, and you go through that process, and then you don't, it doesn't work out because you weren't prepared, or two, you don't get the dollar amount that you think. Maybe in evaluation it looks good,
you're going to get,
but it's not organized. The books aren't good. So it's good to have those discussions years in advance, Brett, as you said, just to have the conversations, kind of start working on it. So you're ready to go to pull the trigger, where you're more in control than being reactive.
Yeah, no question.
Yeah.
No question.
And kind of to that note, we mentioned the seller side, due diligence, quality of earnings, but then we're frequently, our team is brought in to look at the buyer side, or rather I have it flipped, the seller side quality of earnings, to look at really going to, before they even go to the table, to make sure that their books are clean, to make sure that, because the buyer is going to likely do a similar type of an exercise. So last thing you want is all of a sudden there's an EBITDA adjustment of a few $100,000, apply a 5 times multiple, that could be substantial, especially in terms of what their expectation is for the final closing funds.
Yeah, the big surprises at the end, right?
Yes.
Everybody loves surprises, particularly in this kind of thing. And absolutely, yeah. So we've seen these types of transactions. You're absolutely right that buyer does his, seller does his. They compare the two. They don't match. Now what do you do? Right? Then you not necessarily start over, but you know what I'm saying, that then you got to negotiate as to what the really true value of that company is. Yeah, no question. So as we wrap this up today, you guys, any closing thoughts, any closing comments about succession planning and what you would suggest, I guess, for a buyer and a seller in the stuff that we talked about today?
Yeah, I think just the summarize is that try to plan ahead, have your team together. If it's Raymond and Brett here and the team, and it's never too early just to talk. Maybe you're not even thinking of selling. Maybe just have the conversation. So again, you're prepared. If it comes up, you're there. So have your team together. A couple of minds, a lot better than one. think of all the, things that might be out there you hadn't even thought of. And that's
Yeah.
really what the team is here to help you with.
Yeah, that's what we do.
Yeah. No, likewise, really, it's a matter of just planning ahead. We're here to help however we can, perform whatever level of valuation services we can to assist the client, provide whatever value add we can, and take them down that process.
Yeah, I agree 100%. And from the tax side as well, you're absolutely right, Tom. A lot of times we've been working with these people for a very long time. And this is maybe the biggest transaction other than maybe, quite frankly, it might be the biggest transaction they've ever had in their life.
Right.
And there's, whether you're buying or selling, there's social stuff involved, there's nerves involved, there's what am I going to do next involved, over and above just sort of the hard and fast numbers that we always kind of gravitate to because that's our business. As you said, there's a psychology to all of this. What am I going to do after I get that check?
Right.
So, well, you guys, thank you so very much for coming. We really appreciate it. Again, we're so happy that you're here helping us, and we're going to send this out to the Abbey people. Hopefully they'll give it a watch and enjoy it just as much as I did with you guys today. So thank you both very much.
Thank you.
Thank
So
you.
we will close today. Again, thank you so very much, Abbey Carpet, for being such a great client and colleague of ours over the years. And we will see you again next time.